Very good evening to you, all of you students. My name is C. Divas Gupta, and today I will be taking all you through the risk analysis and capital budgeting session. So let's make it more, interactive because if you keep on sending me questions, queries, or even keep on participating in a lot of questions that I'm going to ask, it will be a very fruitful session. And let's keep our focus for the next 2.5 hours in this session so that all of us can take some of the key takeaways from here. Siddharth is saying good evening, Hitesh, good evening, Sneha, good evening, One Reddy, good evening. Yeah. So let us start with the topic. We'll start with some very basic concepts. So what is capital budgeting? I think you have already studied in your previous sessions, in your previous curriculum. So what we can summarize is capital budgeting is actually involving cash inflows and cash outflows, right? So these are the two most important inputs that goes into the capital budgeting model for us to analyze whether this is a good investment or not. Now, while all of these are estimates, because you are standing today, the cash inflows that are going to come in future is also an estimate, and maybe some of the cash outflows that would be going in future would also be an estimate. So here is a estimation involved. That's why there is a risk element involved. Okay, and hence there is a need to understand that what is the risk analysis in capital budgeting. Gomati Krishnan, good evening. Rahul, good evening. Gehani, good evening. Weightage, Rahul is asking about what is the weightage for this chapter. So I might not be the right person to comment on that. Maybe that you can keep it later on for the ICI faculty to answer, right? So, and we should not study the topic. We should understand the topic, wholly without giving any weightage to the weightage, how much weightage it has. Okay. Because, these are some of the really practical principles that will help you in your practical life as well. Siddhant, good evening. Yes. So coming back, now I'm writing 3 terms in front of all of you, right? And I would want to invite, your thoughts. What do you think? What are those? Or what do you mean by those? So the first term is certainty. Second term is risk. And third term is uncertainty. Okay. Aita is good evening. Raghavan, good evening. So what I'm trying to ask is there are 3 terms. One is certainty. Second one is risk. Third one is uncertainty. So what do we mean by certainty? Certainty is which is something is 100% bound to happen. There is no single doubt about of it not being happening. Yes. So Mancha is saying risk analysis is the indication that we are making strategic capital investment decisions. Yes, we will see that, Mancha. Khushi Kankari, good evening. So certainty is something which is 100% bound to happen. And how are we so much certain? For example, there is a contract, there is an agreement in place, right? Let's say agreement for rent. If there is an agreement for rent, that cash flow is bound to happen, correct? You have to pay that rent, and that amount is also certain. That agreement will govern the certainty of that cash flow, correct? Similarly, you have agreement for supply of goods. Supply of goods. Let's say with government, you have a government contract in which you know that what is the price and what is the quantity that you have to supply over a period of time. Don't you think that the amount here is certain? You know that what is going to come, what is the cash flow that is going to come in future. That is called as certainty. Now, risk. Now, Hitesh is saying uncertainty can be happen or may not happen. Yes, that's right. We'll come to uncertainty to understand in detail. Now, what is risk? I'm putting it here. So risk is a scenario where You know that either it can happen or it cannot happen. There are different scenarios. And even you are also not sure that what is the amount of cash flow going to be, right? So this is a kind of situation where, you can make different scenarios. What are those scenarios? Since we are talking about capital budgeting, hence I'm always taking cash flows in my example. Okay. So for example, cash inflows, I am estimating for the future that it can happen 2000 also, or it can happen 3000 also, or it can happen 5000 also, or it can even drop to 1000. Okay. So I am building these different scenarios because there is a risk element involved. I cannot certainly measure my cash flows for the future. Hence, I'm saying that there are different scenarios, and those different scenarios, I assign probability there, because I cannot say that 2000, 3000, 5000, 1000. For me to do some kind of operation on this data, I need to understand that what is the probability for each of this scenario. Correct. So 20%, then I'm, let's say, saying that 3000, there is a 30% chance that 3000 cash inflow will come. Then there is a 40% chance that even 5000 will come. So the highest probability is that 5000 will come. And then there is only 10% chance that 1000 will come. Karthik Gupta is saying, risk means in case of uncertainty, there may situation arise in which we are in loss. It can happen both ways. So risk means that you cannot estimate it properly. There is some kind of estimation uncertainty involved. Your profits can be higher, your losses can be lower, your profits can be lower, or your losses can be higher. It can be all the four directions. So risk means that your inability to properly come up to a certain cash flow, that is called as risk, which in this case we have understood, right? There are different scenarios and hence it is happening. Now let's come to uncertainty. Uncertainty is a situation where you even cannot imagine about the scenarios. Nothing can be estimated. See, at least from the first situation to the second situation, you are able to come up to some cash flows, right? Different scenarios, their probability. But uncertainty is a situation where you cannot estimate anything. Pooja, good evening. So, what are those practical, situations where you are not able to estimate anything? For example, you have launched a new product. New product is launched. Correct. So once the new product is launched, the business, the company which has launched the new product, they cannot estimate reliably what is the next year sales going to be for that new product, because there is no historical data, there is no precedence, there is no historical data, or they cannot apply growth or anything. So that means uncertainty is a situation where you cannot measure your cash outflows or inflows for the future. Now, going forward, I'm just taking risk situation, the second situation, further for us to understand it better. Now, as far as this risk is concerned, okay, I am again putting two statements here. Okay. So the first statement, I am telling that basis this data, I am saying that the average cash inflow is, let's say, going to be 3500. So this is my statement number A, and this is statement number B. So statement number B, I'm saying that, okay, average cash inflow is going to be 3500, but along with this, I'm giving you one more information, which is risk. I'm telling you that risk of cash inflow is plus minus 500. Now, students, please listen very, very carefully, because this is the base on which our next half an hour session is based upon. So, as I said that using this data, 2000, 3000, the different scenarios and their probabilities, you have been told that on an average basis. In statement A, you have been told that on an average basis, the cash inflow will be 3,500. And in statement B, you are told that you are, apart from the average cash inflows, you are also told that there is a plus minus risk of 500. That means which statement is better for you to analyze a capital budgeting decision? Is statement number A better or is statement number B better? Come on, you can answer on the handle. So Mansha is saying mostly startups deal with uncertainty. That's right, because they are also into the new environment. Their business model is very new. They don't know how or predictability it comes. But still, for the valuation purposes, they tend to value themselves and they tend to put some cash flow numbers around their valuation figures. So my question here is that if you are given statement A or statement B, what do you think which is the most useful statement? Pooja is saying B, Shakti Vilan B, Hiral B, Gihani statement B. Karthik is asking, sir, can we say about risk that in risk the cash into estimate may be certain, but the probability of occurrence is different? Okay, let me answer Karthik's query first. So Karthik, even the cash flow is not certain because you have different scenarios. Okay, that's why you have probability. So both ways, even the probability and even the cash flows, both the things are depending on different scenarios, is what I can say. Now, yes, I think all of you are right. Pooja is saying B because more facts are disclosed. Shreya B, Siddharth B, Siddhant B, Hitesh B, Banreddy B. I think only Gayatri is saying A. Tanvi is also saying A. Okay, now let me tell you. Now, till now, whatever you have studied in your capital budgeting, you were never privy of this kind of a statement, which is statement B, right? You were always given in the question that already the cash inflow is estimated. There are no different possible scenarios. You will get 3,500 of average cash flows basis that you compute the capital budgeting decision. But now, if you see students, the reality is not like this, right? The reality is if you are estimating something, then there will be a risk of plus or minus. Now, if you see here, they are actually giving us a range. By this information, what is happening is, by this information, I am telling that, okay, the most likely outcome is 3,500. However, you can expect your cash flows to be as low as 3,000 and as high as 4,000. This is plus 500 and this is minus 500. I hope the analysis of this statement is clear to all of you. Don't you think that this kind of a statement is more useful because it is even telling you that what is the upper range and lower range within which you can get a cash inflow? So this is the lower range and this is the upper range. So minimum to minimum, you can get a cash inflow of 3,000 and maximum to maximum, you can get a cash inflow of 4,000. However, on a best outcome scenario, you can get a cash inflow of 3,500. This is how we will understand this. And hence, B is always better. Correct? So what is now, what we are concluding from here is that this is what is risk is, right? And this is the analysis that we have done in the capital budgeting. So this is how the topic, has been framed, and there is a need to understand this. So hence I can say that risk is part and parcel of any decision making, right? Of any decision making. And capital budgeting is one of them, right? Capital budgeting is what? Capital budgeting, you are doing something to arrive at some kind of a decision. And hence, you cannot ignore risk while you talk about capital budgeting. Okay, now let us come back to the business. Now, in statistical terms, okay, in statistical terms, now I have told you previously in the very layman's language. Now let us come to the technical part. So the average that I have written above, which was 3500, is what? That average is actually mean. In statistical terms, we call it as mean. And the risk, can anyone tell me what is the statistical measure we can say is used for risk? What is the statistical measure we say is will help you in determining the risk? If anyone can write or anyone can attempt. So as I told you, average is equal to mean, and risk is what? I think there is some lag between what. Oh wow. Karthik, variance, Mancha, standard deviation, Shreya, dispersion, Siddhant, beta, Shaktivilan, range, Hitesh, variance, Tanvi, mode. Okay. Very good attempt. Very good attempt, all of you. The right answer is variance or standard deviation, whatever you call. So variance and standard deviation is just a square root of each other. I mean, variance is a square of standard deviation and standard deviation is a square root of variance. So generally we say that variance is what the risk is. Is the risk is the statistical measure that represents risk. Okay, good. Hitesh is saying variance, Hiral is saying variance, Siddharth deviation, Pooja deviation, Gehani covariance. Okay, good. So risk is as good as variance or standard deviation. Now let us come to the techniques, right? We will try to see how we can compute the risk and averages in a particular data set. So now let us go to the techniques. What are these techniques of risk analysis, right? So the first technique, or let's say the first concept in the technique that we have to study is probability. Okay, students. Probability is very simple. I mean, you have been studying this concept, right? Past 2-3 years now in your +2 and other subjects as well. So probability is what? Probability is a chance of an event occurring. Chance of an event occurring, correct? And we all know that it always ranges from 0 to 1, correct? Either there is a chance of 0 for an event to occur, or maximum it will be 1, or we can say it is 0 to 100%, correct? Whatever it is, 1 is as good as 100%. One more thing, students, probability is always useful in forward-looking data, correct? Whenever you see data in any question, correct, it will either be forward-looking or it will be a historical data. I'm giving a very useful tip. While you would want to analyze any question before solving it, just try to see it from a lens that whether you are given a historical data or a futuristic data. Whenever there is a futuristic data being involved, you would always be given some kind of a probability, because in future you cannot estimate everything very reliably. Hence, it will involve some kind of a scenario and some kind of a probability. Now, using probability, we have to calculate two things. One is expected net cash flows, and second one is expected net present value. Okay, so expected net cash flows are what? You are given different cash flows. In my previous example that we have taken, these are different types of cash flows, right? 2,000, 3,000, 5,000, 1,000. So what is the expected net cash flow? Expected net cash flow through this formula is given by summation of I is equal to 1 till n net cash flow of ith multiplied by probability of ith. So what you have to do, you have to just calculate a weighted average, right? You have to take the probability multiplied by that cash flow. Then you have to keep on adding all those different observations. That's all. We will understand this better through a practical problem. Then expected net present value is what? Expected net present value is 1 till n expected net cash flow that you have computed in the first step divided by 1 plus k raised to the power t. So this is what 1 plus k is actually the discounting rate. Okay, because whenever we talk about capital budgeting, there is a discounting that you do that you have already studied, right? So please don't get confused through these formulas. We will just try to understand this through a very practical problem, and that is very easy. Let's go to illustration 1, question number 1. So these are the questions that are already uploaded on the portal. Please refer from there. So question number 1 says that very basic question: probabilities for the net cash flows for 3 years of a project are as follows. Now, students, again, as I told you, this question is futuristic data, right? You are given year 1, year 2, year 3 that is going to come, and hence the question is talking about probabilities. Correct. So year 1, year 2, year 3, we are given cash flows and the respective probabilities. What the question is asking us is to calculate the expected net cash flows. Also calculate the net present value of the project. Simple. Both the things that we have just now seen. And they are saying that using expected cash flows using 10% discount rate and initial investment is 10,000. Very simple, very easy. So they are saying you're talking about a project in which year zero, there is a cash outflow, then 1, 2, and 3. Here there is a cash inflow, here also there is a cash inflow, and here there is also a cash inflow. Okay. Now, year 1, year 2, year 3. I'm doing a solution here. So first of all, let us write the different cash flows. Instead of taking the screen up, I have the different referral with me. So I'm putting it here. Cash flows, I'm just writing from the question itself, 2000. Then it is given as 4000. Then it is given as 6,000 and then 8,000. Let's write the probability as well. 0.1, 0.2, which is 20%, then 30%, then 40%. Then expected cash flow, right? Expected cash flow, as we have studied, is what? Summation of probability multiplied by cash flow. Simple. So we will do here summation, and here we will do multiplication. So it is 200, 0.2 into 4,000 is 800. Then this is 1800 and 8, 4, 32, 3200. Okay. So the total comes as 6,000. Now year two cash flows, I'm just writing, then probability I will write, then expected I will write here. So here it is 2000, 0.2, 4000, 0.3, 6000, 0.4, 8000, 0.1. Okay. Then expected one, if I put it 400, 1200, 2400, 800, and finally 4800 is the summation. Mansha is saying in last chapter future data. So it can happen. See, if the question is very simple, then probability will not be given and still it will ask you, and still it will give you the futuristic data. Okay, if it is very simple, then your job is half done. You don't have to do all this summation, multiplication, and all those things, right? But mostly I'm saying if there is a futuristic data, then use of probabilities should be there, would be there. Hitesh is saying 6,000. Yes, 6,000, you're right, Hitesh. Now, similarly, year three, this is cash flow, probability, and expected cash flow. Cash flow is 2,000 for the first scenario. Second scenario is 4,000. Third scenario is 6,000. Then 8,000. Then this is 0.3, 0.4, 0.2, 0.1. And this is 600, 1600. This comes as 1200 and 800. The total comes as 4200. 4800 is also right, Hitesh. Now, you have got now that what is the best outcome for year 1, year 2, year 3. This is the best outcome year 1, year 2, year 3. Right? Now, it is very easy and simple for us to calculate the present value of cash flows. Right? It's very simple, right? 6,000 is for year 1. So we will divide it by 1 plus 10 percentage, right? Raised to the power 1. Similarly, 4800 is for year 2, 1 plus 10 percentage raised to the power 2. This is simply applying your capital budgeting principles here, because see, till here only your new concept was there, which was calculating the best possible outcome. After that, so it's just a normal capital budgeting question for you, right? You will just apply the capital budgeting discounting rates and then calculate the net present value. 4200 divided by 1 plus 10 percentage raised to the power 3. So the present value of cash inflows is how much? 12573. If you solve this, okay? Then expected net present value. Because when you talk about net present value, then you will have to reduce the cash outflows from that, okay? 2573. This is your cash inflow and this is your cash outflow. Yes, Hitesh, 4200, and Shaktivelan is also saying 4200. That's right. Okay. I hope this is clear. Very easy and very simple, right? First of all, you have to calculate what is the best possible outcome expected value. And then as a next step, using that, you will have to just apply the principle and calculate this. Hitesh, your answer is correct. 12573 is this total and 2573 is the expected net present value. Okay. Now let me quickly go to the next concept. Now the first technique we studied was probability. Second is now variance. Because till now in the previous question, there was no mention about any risk or any variance. Now let us talk about risk or variance element in the questions. So first of all, what is variance? As I told you that variance is what? Variance is actually a risk, and risk is what? Risk is that, now I'll tell you in a very layman's language. Now you have estimated that your best possible outcome in the previous question in year 1 is 6,000. Now the risk is that actually your outcome will be different than the 6,000. Actually, your outcome will be different than the 6,000. That means your actual value or these different possible values are deviated from the best possible outcome. So can I say that it is a deviation? Now I'm coming to the technical language here. Deviation of estimated value from expected value. Okay, now I'll explain this. Now expected value is what? It is 6,000 in year 1. And estimated values are what? These are these 4 different values. 2,000, 4,000, 6,000 and 8,000 in year 1. These are called as estimated values. So whatever is the deviation of all those 4 values from this 6,000, which is the expected value, will give you a variance. Okay, I'll write formula here. So variance is generally denoted by this symbol. Okay, and why we do square is that because this is equal to standard deviation and the square is equal to variance. And as I told you that variance is equal to standard deviation square. Okay. Now this is denoted as variance. So variance is equal to net cash flow for the ith observation minus expected net cash flow that we have calculated, square multiplied by probability, and we will take a summation for all the observations. Simple. Very simple formula. Okay. Now this term, expected net cash flow, is the average, right? And this one is the estimated outcomes, different estimated outcomes, right? That we have just now seen. So for each outcome, for each different estimated outcome, what is the deviation from the mean? And taking a square of that, multiplying it with the probability, and then taking a summation will give us the variance. We will understand it better from the help of one question, definitely. Okay. Now, how do we read this variance? So if there is a higher variance, it would mean that there is higher risk. Lower variance would mean lower risk. Okay. And as I told you that since standard deviation is equal to under root of variance, now I'm writing it other way around. Okay. Either variance is equal to standard deviation square or standard deviation is equal to under root of variance. Hence, this is denoted by this. Okay. And now, students, there is one most important thing, a very, very important thing, just from the understanding point of view. You know that while you open a square root, right, whatever value comes, you always put plus minus. Correct? I think you would be able to recall, because once you open the under root, then you always tend to put plus minus. And hence, in my first example, I had taken that plus minus 500. You remember I told you that is a risk of plus minus 500. So because it can be positive also or it can be negative also, the standard deviation. Okay. However, variance, since it is a square, it is always positive, because for minus, if you do a square, it is also positive. For positive, you do a square, it is also a positive. Okay. So variance is always positive, but standard deviation can be plus minus. Now I'm putting two projects here, project A and project B. Students, please ask any question if you have, or please do let me know if I'm running very fast or there is a conceptual overflow. Please do let me know so that we can correct it accordingly. Okay. Now here's an interesting study. There are two projects, project A and project B. Project A has a standard deviation of plus minus 100 and project B has a standard deviation of plus minus 120. Mean, let's talk about mean. Mean is 500 and this is 1200. Now if you see, the average is 500 cash flow with a risk of plus minus 100. In project B, the average of cash flow is 1200 with a risk of plus minus 120. What do you think? Whether project A is better or whether project B is better? Khushi is saying, feeling like maths class statistical chapter. Okay. Okay. But I'm relating it to the, to the normal concept also, right? I mean, it's not purely statistics. I'm just trying to relate it to the outcome that we are trying to derive for the capital budgeting, right? Now, see, I'm just, you forget about what is standard deviation. I am telling you that there is a risk of plus minus 100 with a mean of 500. Similarly, here 120 is the risk of plus minus 120 and 1200 is the mean, which is the best possible outcome is 1200. Now you tell me which project is better. So project, now if we see, we cannot compare it like this, correct? We cannot compare it like this because first of all, if one thing is same, let's say the standard deviation would have been same, then we would have seen which project has the higher mean. Or if let's say the mean would have been same and whichever project has the lower standard deviation, we would have chosen that. Perfect. Now Siddharth is saying risk-wise A is better, but return-wise B is better. That's right, Siddharth. That is what I was trying to tell you. Siddhant is saying project B, Tanvi is saying project B, Raghavan project B, Sudhanshu is also saying project B, and Shaktivalan also saying project B. Okay. So As you know, Siddharth has very rightly said, risk-wise project A is better, but return-wise project B is better. Now, how to analyze it? So what we can do is we can just simply calculate a ratio of standard deviation divided by mean. I'm ignoring, while calculating this ratio, I'm ignoring plus minus because it will mean both the projects, right? For the comparability, I'm just taking 100 by this, which comes as 0.20, and this comes as 0.10. Now, what is this? What is this? This is 1 unit, sorry, 0.20 risk for 1 unit of mean, correct? 0.10 risk for 1 unit of mean. Don't you feel B is better? Because here, for earning 1 unit of a cash flow, there is a risk of 0.10. And in project A, for 1 unit, there is a 0.20. So Khushi is saying 10 time return. That is perfect. Shaktivalan, A is riskier and B is safer. That is perfect. Hitesh is saying B income wise. And Karthik is also saying B is better with less risk. So I have told you that whenever you are in a dilemma where you have been given some risk and some mean, I mean to say standard deviation and mean. So always use this approach. This, whatever you have calculated here is called as coefficient of. Now this is statistical. Huh? I'm connecting now to the statistical term. This is called as coefficient of variation. Okay. But I've explained you very logically that, you will have to see for 1 unit of mean how much risk you are getting. Only then you will be able to compare it, correct? Because the risk is also different, the mean is also different. In statistical terms, they call it as coefficient of variation, which is nothing but standard deviation divided by mean. Simple. Okay. Now, let us come to question number 2. The question number 2, it says you calculate coefficient of variation based on the following information. Now they are saying straight away that you have to calculate the coefficient of variation. Because while calculating the coefficient of variation, first of all, you should know the standard deviation, the mean, correct? Then only you'll be able to calculate the coefficient of variation. You have 2 projects now, okay? I'm putting here project A and project B. For these 2 different projects, okay, Karthik have some good question. He's asking, sir, why the basic principle is getting violated here, that higher the risk, higher the return, as with 20% risk, only 1 unit is earned, and with 10% risk, also 1 unit is earned. No. Wait, Karthik, see. What has been told here is absolutely true. And what you are also saying is absolutely true. I'll prove you how. You are saying higher risk, higher return, right? I am also saying same thing. Higher return, higher risk. Lesser return, lesser risk. Correct. Compare project A and project B. Project B is a project which has a higher return compared to project A, but it also has a higher risk compared to project A. Correct. This is not a input. This is a statistical measure. We're trying to see through a ratio that if we are trying to earn in both the projects one unit of mean, that what is the amount of risk. The risk profile of project A is highly risky, because here we are getting 0.2 times the risk. Here we are only getting 0.10 times the risk. Okay. That means the risk profile of A is higher, but the basic principle is not getting violated here, because you're getting higher return and you are required to take a higher risk here. Or let's say it's vice versa. Higher risk means higher return. Correct. Okay, let's come back here. We have a lot of things to cover. Good. So Mancha is saying statistics is a branch of finance. Okay, that is a debatable thing, Mancha. I don't know. Rupesh Bimani is saying 0.2 and 0.1 project B. Achha, I think you have calculated the coefficient of variation. Okay, let us see, Rupesh. So let's come back to this question, project A and project B. Okay, now project A, we have different possible events. I'm putting it down, A, B, C, D, and E. There are 5. And then for project A, there is a net cash flow. Then there is a probability. Then we will calculate the expected value. Then there is a net cash flow for project B. Then there is a probability, and then there is a expected value. Okay. So 10,000 is what is given, then 12,000, then 14,000. Friends, for the sake of, in the interest of time, I have already computed these numbers with me. Okay. I'm not wasting the time, at least for calculations, because we have to concentrate more on solving a lot of problems as well as getting the conceptual clarity. Okay. Now, so probability also I have put it. So the expected value 10% multiplied by 10,000, 1,000. Okay. Similarly, 20% multiplied by 12,000, 2,400. Similarly, 5,600, 3,200, then 1,800. The total comes as, summation of total is coming as 14,000. Oh wow, I'm getting answers also. Hitesh has solved it. Very nice, Hitesh. We will just see. Project B is net cash flow of 26,000, 22,000, 18,000, then 14,000, and then 10,000. Probability is 10%, 15%, 50%, 15%, and then again 10%. So the expected value, 26,000 multiplied by 10% comes as 2,600, then 3,300, then 9,000, then 2,100, then finally 1,000, and the total comes as 18,000. Okay. So what we have done here, first of all, we have tried to calculate the average, or let's say the best possible outcome for project A and project B in terms of the cash flows. This is nothing but your mean. This is also mean. This is also mean. So our mean calculation is done. Now let's see the standard deviation. Okay. So for calculating the standard deviation, calculation of variance. You can calculate anything, standard deviation or variance, that's okay. Whatever is asked in the question, just do focus on that. Because if you have calculated one thing, other thing is very easy to calculate. Now, again, event, I am putting it here. There were 5 events, A, B, C, D, and E. Now, for A project, okay, 10,000 was the first possible cash flow, right? And 14,000 is the best. So 10,000 minus 14,000 square multiplied by probability of 0.10. Similarly, second one was 12,000 minus 14,000 square multiplied by the probability of 0.20. Third one, 14,000 minus 14,000 square multiplied by the probability of 0.40. Then 16,000 minus 14,000 raised to the power 2 multiplied by the probability of this event was 0.20. Then finally 18,000 minus 14,000 square multiplied by the probability of 0.10. Now if we solve this, we will get 16 lakhs, 8 lakhs, nil, 8 lakhs, and then again 16 lakhs. Now let us see for project B. Project B also similarly, we will do the same computations. So the first possible event was 26,000. Our average that came out was 18,000. So 26,000 deviation from 18,000 will come through the square multiplied by 0.10. Okay, which is equal to 64 lakhs. Then next one will come as 24 lakhs. I'm just writing the values. Then 24 lakhs. Then 64 lakhs. And hence the total, which is the summation, comes as 48 lakhs and this is 1 crore, sorry, 1 crore 76 lakhs. This is your variance, right? Perfect. Now, Hitesh, your answer is right for both project and standard deviation. Karthik. No, Karthik, you keep on asking whatever questions comes to your mind. I'm not saying we are running out of time. No. We have a lot of time. The queries should be answered, okay? So keep on asking as many queries as you can. Hitesh, project B is also you are right, calculated right. Shakti Velan, 18,000. Okay, you have given the answer for this 18,000. Perfect. Hitesh, you are right. Your answer is perfectly right. And Shakti Velan, your answer is also right. Now, this has come as variance. Now, we'll have to calculate the standard deviation, right? Standard deviation will be under root of 48 lakhs. Here it is 1 crore 76 lakhs, correct? So the standard deviation comes as 2190.89, 4195.23. Now I am not putting here plus minus. There is no need to put actually, but for the understanding purpose, we should always know in our back of the mind that it can be plus also, it can be minus also, right? Now, wait, I'm running out of sheets here. I've added, okay. Now the coefficient of variation is what? Standard deviation by mean, correct? So that we can calculate for project A is how much? 2190.89 divided by 14,000. Similarly for project B, 4195.23 divided by 18,000. Perfect. Shakti Velan, your answer is right. Both the answers are right. Hitesh, yes, your answer is also right. 0.1565, 0.2331. Okay. So this is what the question had asked us to calculate. Very easy, very simple marks if these type of questions comes. Although these are, calculation intensive, but very straightforward. Now, very good. Hitesh is also even, giving some kind of a conclusion. So definitely project A is better because for 0.156 is for 1 unit and for project B it is 0.2331. Very good, Hitesh. I'm really impressed. So project A is definitely better. Why? Because project A is having a lesser coefficient of variation. It will give you lesser risk compared to 1 unit of your cash flow. Shakti Velan, you're right. So Karthik, you're asking what does this coefficient says here? So this coefficient is saying that for 1 unit of this, which is mean, which is getting the cash flow of 1 rupee, you have to expect a risk of 0.1565. That is what the coefficient is saying. And for project B, similarly, for taking 1 unit of a cash flow, you have to expect a risk of 0.2331. So that means project A is definitely better because it is giving you a lesser risk. Rupesh is saying 1.5A and 2.3B. So project B is not better. Project A is better, Rupesh. Because project A, you are getting lesser risk, right? You're dividing SD divided by mean. Standard deviation is coming lesser, correct? Okay, now going further, you would be surprised to see something similar came up in November 2020. Now let us read the question. A Limited is considering two mutually exclusive projects X and Y. You have been given the below net cash flow probability distribution for each project, project X and project Y. Net cash flow probability, net cash flow probability. Simple. For project X and project Y. What they are saying, expected net cash flow of each project, which is nothing but mean. Variance of each project, which is, we know that this is risk. Standard deviation is square root of mean. The same steps that we did just now. First of all, we calculated mean, then variance, then standard deviation, and then finally the coefficient of variation, so which is standard deviation by Mean. Generally, we represent mean by this x bar. Okay. So I'm not solving this question. I'm leaving it. But the question is very similar to what we have just now attempted. Exactly similar. Okay. Then it is also asking you to identify which give reason. So wherever in whichever project the coefficient of variation is lesser, you will definitely recommend that. Correct. Okay. Now let us come to the to the next level. Now we have understood. See, we have understood first of all what is risk. We have understood that there were three kind of scenario situations that we have taken: certainty, risk, and uncertainty. Certainty and uncertainty, I have leaved it. Risk, we have taken it further. Within risk, we have studied that if you are given whatever is the average, what is the risk, it will be a better decision making opportunity for you. Plus and minus, you will be able to evaluate. Then within that, we have also studied that what is the probability, what is the variation, what is the variance, and what is the coefficient of variance. Right? Now comes the next topic called as risk adjusted. Now this is very interesting, very, very interesting actually. Now there is no further statistics. Statistics was still here only. Probability, variance, coefficient of variation, right? Now let us. This is very practical concept, students. Very, very important and very good concept. Now I'm again, I'll ask you certain questions and we will build our concept around it. Okay. So don't get threatened by this name, risk adjusted discount rate. It is a fancy name being given, but concept wise, it is very beautiful concept. First of all, can anyone tell me why is interest paid? What is the reason for which we have to pay the interest on the loan that we have taken? Or let's say, why do we expect the interest for any investment that we have made? What triggers interest? Why in this world this transaction called interest exists? Let us first understand that. Please, yes, very good, Mancha. Time value of money. Very nice. And Siddharth is also saying because this is a time value of money. Nice. What are the other things that you can think it of? Time value of money is definitely one. I agree with you. I'm putting it here. Time value of money. Very nice. Now I'm getting a lot of answers. Prabhas Jain is saying as the value of money decreases with time, which is nothing but the time value of money. Hitesh is saying for the services we get in the form of loan. Okay. Pooja is saying time value of money. Gehani is saying future cash flows. Sudhanshu is saying because this is the cost of debt. Karthik is saying time value of money as it falls, so we expect some compensation. Very nice. Siddhant is saying time value of money. Raghavan, interest is paid for the opportunity cost. Okay, nice. Now, see, this is a different answer. Neha is saying interest is reward for the risk borne by the lenders. Very nice, Neha. Pravas is saying as in charge for lending. Okay. Siddharth is saying because I lose opportunity cost with that money. Definitely, there is an opportunity cost. And there was one more answer of opportunity cost that was given. Pooja is saying today 100 rupees is not tomorrow 100. Example due to inflation. Very nice. Now, all these answers can I club in two buckets? And you tell me, one is time value of money, which is deteriorating because of inflation. Today value of 200 is not as good as 1 year value henceforth. Hence, the value of money always keep on depreciating. So hence there is a time value of money involved that all of us know. Khushi is saying returns. Siddhant is saying compensation for undertaking risk. Very nice. Mancha is saying inflation, purchase power of parity. Okay. Now let me bucket all the things into two. Very good, all of you for participating and giving very good thoughts. I think this this bunch of students that we have currently is the thought process is very good and on the point. So one is definitely time value of money, and second is risk. Okay. So time value of money, as all of us know, that the let's say one basket of goods today is costing, let's say, 100 rupees. The same basket of goods 1 year from today might cost 120, right? So there is an inflation. There is a general inflation, right? So the time value of money always is the one of the factor. Then what? Why there is a element called risk? So the risk is, what is the risk? Now, if I lend money to someone, my entire money is at stake, right? There is a risk that I will not get my money back. Is my screen not visible? Hiral is saying screen not visible. Pandava is saying to encourage lenders to get more returns. Okay. Now, if I am lending some money to anyone, that means there is a high probability or there is a high risk that I might not get my money back, even the principal amount also. So, hence, I would expect some kind of a return there to cover up that risk as well. Because, as okay, Karthik, thank you, Siddharth. All are saying visible. Okay. Hitesh is also saying visible. Okay. Hiral, please check network at your end once, because this is at your end only. The problem is coming. Rest all it is visible and audible. Okay. Perfect. So what I was saying is that in case of a risk, there is a risk of non-payment of principal as well as interest. Hence, I would expect some kind of a premium, right? Because there was a question or there was a query also which said that higher risk, higher reward. If there is a higher risk I am undertaking, I will expect higher return in the form of interest. So I can say that risk of non-payment, right? And hence there is a issue that I will not get the money back. That's why I'm charging interest. Okay. So time value of money and risk. These two things takes all the parameters. Now, the risk adjusted discount rate concept says that you use a discount rate while you take the capital budgeting calculations, right? There is a discount rate that all of you use. Now, it says that if you feel that that project has a very high risk, you increase the discount rate, because discount rate is also how it is computed is it is risk free rate plus risk premium. So what is this risk free rate? This is a general risk free rate. Even if there is a project with zero risk, bare minimum I would expect this risk free rate. Let's say 7%. I'm assuming this is 7%. This is, let's say, in the government bonds. Any bonds issued by the government of India, or let's say any government of a country, is always considered as risk free, because government will not default, right? These are the most secured investments, hence those are called as risk free. So that's why bare minimum from any investment I can expect 7%, which is the risk free rate. Plus, if there is a risk element involved, then I will charge a risk premium, and hence I will increase my discount rate. Let's say, depending on my any calculation, what I did, I came to know that at least 8% risk premium I have to charge because of the risk involved in that particular project, and hence my discount rate will be 15%. Now, what have you done here? You have adjusted your discount rate. Why? Because you've adjusted your discount rate. Why? Because you know that the cash flows are risky in nature. Hence, I cannot use 7% as a discounting factor. I have to add some premium and use 15% as a holistic rate. Now, ultimately, I'm taking two scenarios. Let's say scenario 1 and scenario 2. Now, scenario 2 is a situation where I feel that the risk premium I should only take as 4%. Hence, the discount rate in scenario 2 will be 7 and 4, 11%. Okay. Now we will compare both these. Okay. Rupesh, you are right. Lower risk project A. You would be answering the previous question. Siddharth is saying FD. Yes, FD is, as you know, FD is very risk free. Karthik is saying, sir, can we say interest if seen on basis of time value of money only? Then the present value of interest principal is the amount we invested, and we expect something in return of risk from the later party. Then such present value may different as it will be an agreement between the parties and not time value of money. Okay, what I understand, Karthik, from your query is that, see, somewhere my answer lies here only, that definitely the present value of whatever you expect in future is the real value, correct? Because there is a time value of money involved. But how to do that present value is what we are trying to see using the discount rate. Okay, Karthik. Karthik is saying yes, and the compensation of risk is profit. Definitely yes. Okay. Now I'm comparing these two situations. So scenario one, which says that 15% discount rate, scenario two, which says that 11% discount rate. Okay, Gihani is saying, please explain the discount rate again. Prabhas is saying RADR is equal to RM, right? As RM minus RF is the risk premium. Okay, Prabhas, I think we should not apply the CAPM principle here, capital asset pricing model principle here, because generally there we study that, return in market minus risk-free rate of return is the market premium. Okay, that we should not apply, because see, this is not the market premium. This is the premium specific to this particular project that we are evaluating. Okay, hence this risk premium should be seen in view of that project. Okay, so better that this risk premium would always be given in question. Otherwise, there is an element called beta, right? We have a risk premium for a security. Similarly, we can have a risk premium of a project also using that beta. Okay. I will explain the discount rate again, Gyani. Mancha is saying long run project or short run project, which one is more riskier? It can be anything, Mancha. Even long run can be riskier or short run can be riskier. It depends, what is the element or what is the risk profile of a particular project. You cannot conclude that short term are always less risky and long term are always more risky. The riskiness of the project depends how the cash flows are skewed, right? Yes, Kiral. I'm explaining again the concept of risk-adjusted rate again. Okay. So, as I told you that, first of all, what is interest? Why do we pay interest? Interest is paid for two things. One is the time value of money, because the money keeps on deteriorating. 10 rupees today will not have the same value 10 rupees 1 year down the line. Similarly, there is a risk element involved. If I lend money to someone, I undertake a risk, and to compensate that risk, I would expect something more than the time value of money. Because if I only want time value of money, I can go and invest in the government bonds. Those will simply compensate me for the time value of money. But since I'm not investing in government bonds, I'm investing in this particular project. Hence, there is a higher risk involved, because ultimately, the return that I expect will not come, or let's say the amount that I've invested, I will not be able to get it back from the project. It can happen, right? So this is a risk. Hence, we said that discount rate that is used in discounting the cash flows is a combination of, again, two things. One is the risk-free rate, which is as good as time value of money, and one is the risk premium. Risk premium is something that we will calculate, saying that, just a second. So the risk premium will come when we will come to know, okay, this is the variability in the cash flows. 8% should be the right amount. Okay. Okay, I think there is. Okay. Now, what I was trying to say is that this is the discount rate. Discount rate is a combination of two things: risk-free rate as well as the risk premium. Okay. Now I have taken two examples. I am saying in one scenario, the risk premium is only 8%, and in the second scenario, the risk premium is 4%.
Hence, the discount rate in the first case, it comes as 15%, and second case, it comes as 11%. Now, this is called as risk-adjusted discount rate, because whatever is the risk, depending on that, you have adjusted your discount rate. In the first case, you think that 8% is the right adjustment. In the second case, you think that 4% is the right adjustment. Now, you tell me, if you feel that discount rate in the first scenario is 15%, in the second scenario is 11%, can you tell me which project is more riskier? Let's say this is in project A and this is in project B. So can you tell me which project is more riskier? Yes, Karthik, you're right. That is what we can say in a nutshell. These are the two elements, right? Now, please concentrate here. What I'm trying to ask is, students, if I have concluded that project A has to be evaluated using a discount rate of 15% and project B has to be evaluated using a discount rate of 11%, which project is high, is risky, is more risky compared to the other project? Dihani, risk premium is not on judgment. It has a proper calculation, but that calculation we don't have in our scope as of now. Okay, there will be some kind of an indication that will be given in the questions. So when we will solve the question, we will see that. Dihani, Ban Reddy is saying A, Hiral is saying A, Siddharth is saying of course project A, Prabhas is saying project A, Sudhanshu is saying project A, Siddhanteli is saying project A. Karthik is saying, no, we need to see how much risk factor is there. Only by using this rate, we can't assess risk. Okay. Shreya is saying project A because NPV will be low. Very nice. Some of the very beautiful thoughts. So as of now, Karthik, assuming that this is the only information available with us, okay, definitely project A is highly risky because it is highly risky. Hence our discount rate is also higher. The moment you use 15% instead of 11%, your present value will be lesser. If you use 11% instead of 15%, your present value will be higher. Hitesh is saying A, Shakti Vilas is saying A. Perfect. Okay. So just keep one thing in mind. Higher discount rate means higher risk in the project. Lower discount rate means lower risk in the project. And this is what is risk adjusted discount rate is. You have to adjust your discount rate in such a way that it takes into account the risk of that particular project. Okay. But there is one limitation. Okay. What is that limitation? Limitation is very simple, that it assumes automatically, this kind of a scenario assumes that in all the years, risk is same. Because in all the years, you will be using 15% or 11%, right? So it does not allows flexibility that in 1 year risk is something else, in second year risk is something else. So it does not take that into consideration. It always assumes that in all the years risk is same. That is one of the limitation. Okay, students. Now let me go to second concept, which is very much related to this. Certainty equivalent method. Okay. Just to tell you, risk adjusted discount rate has nothing to do with any statistical thing. It is a very simple concept. It says that if you are evaluating a capital budgeting decision for a risky project, use higher discount rate to discount the cash flows. Simple. A very easy concept. If you are evaluating a capital budgeting decision which involves lesser risk, use lesser discount rate to discount the cash flows. Okay. Perfect. Pandava is saying project A. Gyani is saying clear. Okay. Thank you, Gyani. So certainty equivalent method, what does it says is, now again, I'll explain using some scenarios. Okay. First is, let's say, situation 1, situation 2. Hitesh is saying clear everything. Perfect. So situation one, I am assuming that while estimating the cash flows, okay, like in my first part of the session, I told you now that certain cash flows means those are 100% guaranteed because those are covered by an agreement for rent, agreement for supply of goods to a government party. So you know that in future that cash flow is going to happen, correct? And second case I took about risky situation, right? In which I told that you don't know how much is going to happen. There will be different possible events. So if I say that in situation two, guaranteed cash flow is going to happen is 1,50,000 rupees. Okay, this is guaranteed. This is going to happen. This is certainty equivalent cash flow. I hope you're able to relate it, correct? So the guaranteed cash flow is 1,50,000 that is given to you in situation two. For the same project, I will say that if guaranteed is 1,50,000, can I say that risky cash flow is 2 lakhs? Can I say this? Yes, very much I can say this. Why? Because if there is an element of risk, it will be higher than the guaranteed amount. If there is an element of risk, it will mean that higher cash flows than guaranteed, right? Then only I will take a risk. No, otherwise I will not take a risk, correct? If the risk is higher, then only I will take the if the risk is higher, then only I will ask the cash flows to be higher, right? In my example, and guaranteed means 1,50,000 is definitely guaranteed. Whatever come or whatever may go, you will get at least 1,50,000. So guaranteed will be lesser, correct? So now you can always see in this in your regular negotiations also, where you feel that you don't know what is the value going to be, then definitely there is a higher value attached to that particular thing. But if you know that, okay, now this is the value that is there guaranteed, the value tends to be lesser, correct? Because the risk element is not there. Now what we have to do is we have to just find this term called coefficient of certainty equivalent. This is called as very easy and very simple. 1,50,000 is the guaranteed one and divided by 2 lakh is the risky cash flow into 100. 0.75 is the coefficient of CE. This we called as coefficient of CE. What we have done, we are actually stripping down this 2 lakh into two parts. One is 1,50,000 and one is this 50,000. This 2 lakh is what? Risky cash flow. This is guaranteed cash flow. This is risk premium. Correct? I hope this is understood now. Like in RADR, risk adjusted discount rate, we were using risk-free rate plus risk premium. In certainty equivalent approach, we are actually targeting the cash flow and we are dividing that into two parts. One is the guaranteed cash flow and one is the risk premium. We are stripping down the risky cash flows into two parts. Okay. And please remember this term, students. This term is called as coefficient of certainty equivalent. This will help you to convert the risky cash flows into the guaranteed cash flows or guaranteed cash flows into the risky cash flows. Simple. Okay. Now, I will just compare both the concepts that we just now studied. This was risk adjusted discount rate and this was certainty equivalent method. Okay. Now, risk adjusted discount rate, what does it say? If you have a risky project, you increase the discount rate. Increase the discount rate. Correct. In case you have a risky, wait, let me do one thing. Let me remove this line. Yes. In case there is a risky project, it asks you to increase the discount rate so that the net present value comes less. In certainty equivalent approach, it asks what? In case of a risky project, it asks you to reduce the cash flows. Simple. You reduce the cash flows by applying a certainty equivalent coefficient. Instead of taking 2 lakhs, you take 1,50,000, which is the guaranteed cash flow. And hence you're reducing your cash flows, right? And hence you are trying to analyze this project better, which is a risky project. Now, what does this impact have on NPV? Impact of low NPV. Similarly, here also, this will also have an impact of low NPV. Okay, simple, understood? Now, the limitation here for RADR, what we discussed was, it has the same risk premium for all the years, right? But this limitation is overcome in certainty equivalent approach, because you can have different coefficient of CE, correct? You can have different coefficient of certainty equivalents for different years, and hence you will be able to evaluate it better, because at a yearly level you can evaluate the risk, right? We will see through proper examples. Now, very important thing, okay? Very important thing. Either RADR or CE. This, please remember, students, you cannot use both the approaches in a one project. Either you can use RADR or you can use CE. Now, what does this mean? I'm putting here one simple table, cash flow and discount rate. Okay. So for using, while you use RADR, what you have to do, you have to take the risky cash flows and risk adjusted discount rate, right? But while you use CE, then you have to use guaranteed cash flows and risk-free discount rate. I hope this is clear to all of you. Risk-free discount rate. Correct? Because in certainty equivalent approach, you are using guaranteed cash flows. Those guaranteed cash flows you cannot discount using a risk-adjusted discount rate. You will have to take the risk-free discount rate to discount it. So hence I'm saying either you can apply RADR or you can apply CE in a particular question. Okay, so now students is 7:18. Let's break for, okay, wait. There is a query. Hitesh is saying crystal clear. Siddharth is saying, so in short, both of them work in opposite principles. So Siddharth, principles are same, but the method of applying is different. The principle is higher risk should have a lower present value. Whether you do it using cash flows or you do it using discount rate is a choice given in RADR or CE. But the principle is very much similar. Principle is higher risk, lower present values should be there, because then only it will make sense, right? Okay, students. So now we will break for 10 minutes. We will again come back at 7:29. welcome back, students. There are some of the queries that are posted. So Karthik is saying only approaches are different. Yes, only approaches are different. The end objective is same in both the things. Hiral is asking, please explain one example, sum on C method. We will do multiple of them, Hiral. We will do through our practical problems. Then Shreya Shah is asking, sir, why it has been assumed in RADR that risk premium should be same for all asset class? See, for all assets, we are assuming the same risk premium. That is true because in a capital budgeting. So see, Shreya, what I can answer your question is that for that particular project of the capital budgeting which we are evaluating, for that we are assuming that risk premium will be same. Okay, within that, whatever are the assets, for all those assets, the risk premium will be same. That is also one of the limitation because it will not give you flexibility. Cash flows, on the other hand, gives you flexibility to, to cut down or whatever to do at whatever project level. But in this, the same rate is there, the same risk premium is there across all the years as well as across the same project. Okay, now let us come to question number 4. Yes, so question number 4 says Gaurav Limited is using certainty equivalent approach in the evaluation of risky proposal. The following information regarding a new project is as follows. For the years, they have given expected cash flows. Then they have given the CE quotient. Okay. Riskless rate of interest on the government securities is 6%. Determine whether project should be accepted. Very simple and very easy question. It will help to brush up your concepts, okay, of certainty equivalent approach. So I'm putting solution here. We are given that 0, 1, 2, 3, 4, and then 5. We are already given expected cash flows. Okay, there is no probability here. There are no different possible scenarios. All that is gone. All that is the first part of the lecture that we have already understood. 4 lakh negative, which is outflow. Then 3,20,000 is an inflow. 2,80,000, 2,60,000, 2,40,000, and 1,60,000. These are the expected cash flows that are given. The certainty equivalent coefficient is given as 1, 0.8, 0.7, 0.6, 0.4, and 0.3. So the risk less cash flows will be what? We have to eliminate the risk, right? Now, certainty equivalent 0.8 means that 20% is the risk premium. 80% is the guaranteed cash flow, which is riskless cash flow, right? So we have to multiply this. 1 multiplied by 4 lakh, 4 lakh. 0.8 multiplied by 3,20,000. This comes as 2,56,000. 0.7 multiplied by 2,80,000. This comes as 1,96,000. These are the guaranteed cash flows that we are putting, okay? 1,56,000, 96,000, 48,000. The present value at the rate. Now, very, very important thing. Since we are using CE approach, the discount rate to be used is the riskless rate of return, correct? We cannot use the risk premium discount rate, which is the RADR. We cannot use that. As I told you, either you can use this or you can use the other one. So the present value at the rate of 6%, it comes as 1, 0.943, 0.890, 0.840, 0.792, and 0.747. Okay. And last step is just a simple multiplication of this present value factors multiplied by the riskless cash flows. So we are using the riskless present values factor and multiplying it with the riskless cash flows. That is what the certainty equivalent method is. So total present value is, so 1 multiplied by 4 lakh will be 4 lakh. Then 241, 408, 174, 440. So this is coming as 0.890 multiplied by 1,96,000. This is simply your capital budgeting now, correct? See, what we have studied new here is only this. That's all. Rest all is your normal capital budgeting technique, right? 131, 040, 76, 032, 35, 856. So the total amount comes as net present value comes as 258, 776. Okay, students. So I hope this is very easy and very simple now. How to apply the certainty equivalent approach. Okay. Now, let us see this question. Question number 5. Any queries, please do post. Now, question number 5 says that a project requires an initial outlay of rupees 3 lakhs. Okay. The company uses certainty equivalent method approach to evaluate the project, the risk-free rate, which we also need, correct? We also need the risk-free rate that is also given in the question. The following information is available. Cash flow after tax is given and the certainty equivalent coefficient is also given. So that means 1 lakh is the risky cash flow and 90,000 will be the guaranteed cash flow, right? 1 lakh multiplied by 0.9. That's how it is given for all the number of years, and the present value factor is also given. This question came in January 2021, and the same type of question we have just now solved. So again, I'm not solving this. This is a very similar question. We have to just multiply these numbers and arrive at the riskless amounts, correct? And multiply it with these factors, simple. And we will get the net present value and reduce 3 lakh rupees of initial outflow. Okay. Okay, student, just a second. Meanwhile, I'll project this sheet to you. Just log in again. Actually lost the track of the question. Just a second. Huh? Perfect. Somehow I got logged out. So okay, I have some questions now. So Hiral, we have just now covered one of the example on the CE method. Hiral is again asking, is it compulsory to write conclusion in all the answers? Better to write. Okay, now in this case, you can just write, what is the question asking? The question is asking to evaluate the project, right? Hence, once you get the NPV, then you can say, after getting the NPV of this much, the evaluation is that the project should be accepted or rejected, something like this. Okay. Siddharth is asking, sir, so really these kind of problems will come? I mean, I say no. Siddharth, you cannot conclude that. Okay. I mean, questions are never easy or difficult. Whatever you know is easy, whatever you don't know is difficult in examination. Okay. But here the focus should be always on concept building. The concept building has to be strong and it has to be coupled with the proper explanations on the illustrations or the practical problems. Okay. You Bharadwaj is saying, sir, in formula risk your expected cash flow should be divided, but you are multiplying. No, it should be multiplied only. Na? See, if you see what is the CE coefficient, what is the CE coefficient? CE coefficient is guaranteed divided by the risky one, right? Now, if I ask you to calculate the guaranteed, see, CE is equal to guaranteed divided by risky one. Now, if I ask you to calculate the guaranteed one, you will calculate CE multiplied by risky, right? That's how you will do, and that's how we are doing. Okay. Hiral is saying, yes, sir, you told correct. Paper is easy if we know the answers, and paper is difficult if we don't know the answers. That is the main highlight. Yes. Okay. Question number 5, I'm leaving. Then question number 6. Very good question. So 6th question, it says that following information have been retrieved from the finance department of a corp finance limited relating to projects X, Y, and Z. Okay. There are 3 projects that are being given. Net cash outflows are given, project life is given, annual cash inflows is given, and coefficient of variation also they are given to you. Coefficient of variation, don't forget students, you have just now studied, it is standard deviation divided by mean, correct? You are required to determine the risk adjusted net present value of the projects considering the company selects the risk adjusted rate of discount. Now see student, this is a question on RADR, right? Till now we were studying on CE, this is a question on RADR on the basis of coefficient of variation. Now they are saying that the company selects RADR basis the coefficient of variation. We just now studied if coefficient of variation is high, the RADR will also be high. Because the risk is higher, higher the risk, higher the premium, higher the premium, higher the RADR. Everything is related. Lesser the coefficient of variation, lesser the risk. Okay, let me start 1 point back. Lesser standard deviation means lesser coefficient variation. Coefficient of variation lesser means lesser risk premium. Lesser risk premium means lesser RADR. Everything is related, correct? That's how we will see here. Coefficient of variation, if you see, as it is increasing, the RADR is also increasing here. And these are the present value factors. A very simple statement. Showing calculation of risk adjusted net present value. Now there are projects X, Y, and Z. Cash outflow is given for all these projects. For this project, it is 42 lakhs. Second one is 24 lakhs and then 20 lakhs. Coefficient of variation. I'm just writing in the very short form. Please don't write. I suggest you guys don't write the short form. Please try to mention the full form, okay? 2, 0.8 and 1.6. Now basis this RADR, we can take from the table. Now if coefficient of variation is 2, RADR is 20% and the present value factor, annuity factor is 2.990, okay? So it is 20%. Similarly on 0.8 is coming as 12% and 1.6 is coming as 16%. Annual cash flows are how much? 14 lakhs per annum, 8,40,000 per annum, and the last one is 6 lakhs per annum. Then the present value factor is also given in the question. How? So 20% factor is 2.990, 12% factor is 3.640604, and 16% is 3.274. So the discounted cash flow is this multiplied by this. Okay, 4,186,000, 3,027, 360, 1964, 400, 1964, 400. Okay, we can't do total because these are three different projects. So the NPV X, Y, and Z. 42 lakhs is the initial outflow. 24 lakhs is the initial outflow, and 20 lakhs is the initial outflow minus the incoming, the cash inflow. I'm saying 41 lakh 86,000, 30 lakh 27,360, 19 lakh 64,400. What is the value? It will come minus 14,000, 6 lakhs 27,360, and minus 35,600. This is the NPV I have calculated. Okay. Hitesh is saying 4186 perfect, 3019 perfect. Hitesh, and the difference is also fine, right? Very good. That's all. We have calculated the NPVs. So the Y is actually the better project, we can say. This is the risk adjusted NPV. Simple. Okay, students. Now let us go to the next question. So the next question says that a textile manufacturing company limited. Students, again, I am saying if there are any queries, please do post them. Please do ask as many queries as you have. The Textile Manufacturing Company Limited is considering one of the two mutually exclusive projects, Project M and Project N, which require a cash outlay of 8,50,000 and 825 respectively. So there are two projects, Project M, Project N, and both of them have different cash outflows that they have given. The CE approach is used in incorporating risk in the capital budgeting decision. Very nice. This is a question on CE. They are saying that the company uses CE approach. That means they convert the risky cash flows to the guaranteed cash flows using the CE method. Karthik is saying, okay. Oh, but you can also do it, Karthik. I mean, Hiral is saying this chapter is relatively easy in calculation compared to capital budgeting. Okay, Hiral. Nice. So the understanding has to be good. Okay, if you have a good understanding and good grip on the concept, everything is easy. Again, I'm telling you, there is nothing called as easy and difficult. Okay, now it says that two projects were there, and for those two projects, they use CE approach in incorporating in capital budgeting decision. The current yield on government bonds, is 6%. That means they have given you the risk-free rate of return. Correct. And this is used as risk-free rate. That is what they are also saying. The expected net cash flows and their certainty equivalents are given as follows. Project M and Project N, these are the certainty equivalents as well as these are the cash flows that are given. Very nice, Hitesh. Hitesh has already solved the question. Present value factors of ₹1 discounted at 6% are also given to you. Analyze which project should be accepted. If the risk-adjusted discount rate method is used, identify which project would be appraised with a higher rate and why. Thanks a lot, Siddharth. Thank you. Okay, now Project M. It is very easy now, right? We have to first apply the certainty equivalent method on the cash flow and calculate the present value using the 6% rate. Simple. So 4,50,000 multiplied by 0.8. I'm just taking a shortcut in presentation, okay? And I'm applying this 0.943 because I have to just explain you the second part of this question, which is very, very important. 5 lakh multiplied by 0.70 multiplied by 0.890. Then another 5 lakh. This is year 1, 2, and 3 multiplied by 0.50 multiplied by 0.840. So the total of this is coming as 8,60,980 less initial cash outflow of 8,50,000. So the NPV is coming as 10,980. Similarly, this is for project M and project N. Project N is 4,50,000 multiplied by 0.90 multiplied by 0.943. 4,50,000 multiplied by 0.80 multiplied by 0.890. 5 lakh multiplied by 0.7 multiplied by 0.840. So the total here will be 9,96,315 less 8,25,000, and hence the amount here comes as 171,315. This is the NPV. Okay, so project N has an NPV of 171 and project M has an NPV of 10,000 only. So we should accept project N, correct? Hitesh, you are right. Project N should be accepted. You, Bharadwaj, you are also right. Both the answers are correct. Okay. Now, students, I want all of you to focus here. Just focus only on the certainty equivalent amount, coefficient of certainty equivalent for project M and project N. So, what do you think? Project M is more risky or project N is more risky? If you can tell me only by looking at their CE, which is the coefficient of certainty equivalent. Whether this is more risky or whether this is more risky. This has a higher value and this has a lower value. Project M has a lower CE, project N has a higher CE. So whether project M is more risky or project N is more risky. Pooja is asking, where are these questions? Pooja, these questions are already uploaded in the portal. Please check once. More risk, more profit. So N is more risky. Don't apply that principle universally, you Bharadwaj. See, that has to be seen in a particular context only, right? Karthik is saying M is more risky. Siddharth is saying M is more risky as certainty is less. Very nice. We are getting the answers now. You Bharadwaj, we cannot conclude more risk means more profit and hence whatever is more NPV, it would be more risky. We can't assume that because see, the profit does not only depends on risk. Okay. Directionally, we always say that higher risk, higher reward, but profit never only depends on risk. It has lot of other factors also. Hitesh project M, Divyanshu project M, Pandava project M, Gayatri Pandava project M, Gihani Hariram project M, Karthik certain inflow is more in N, so it is less risky. Very, very nice, Karthik. So I think all of you are having the right thought process. Project N is less risky and project M is higher in risk because if you see 0.8, so that means 0.20 is the risk premium and 0.90, 0.10 is the only risk premium, right? So risk premium is higher in project M. That means project M is more risky. If project M is more risky, then if we use RADR, don't you think this would be evaluated at a higher rate? Yes. Hiral Parekh is asking certainty equivalent means what? Certainty equivalent. See, as I told you, 2 lakh is the risky cash flow. 1,50,000 is your certain cash flow, certain / guaranteed, whatever you want to call it. So 0.75 is the certainty equivalent amount of 2 lakh. For every 1 rupee in this risk, 0.75 is the certainty equivalent amount. So for 2 lakh, it will be 1,50,000. This is called as certainty equivalent. Okay, Hiral. Now let us go further. No, I have to just write here project with lower CE, certainty equivalent, would be evaluated using higher discount rate as it implies higher risk. Okay, students. Simple. This is our conclusion here. Now, last part of this session, other techniques. Okay. Now, what are the other techniques? See, till now we have studied probability, variance, risk-adjusted discount rate, certainty equivalent approach. Okay, now we will study some of the very broad techniques. Sneha is saying N. Pooja is saying, can you please show M? No, I don't know. Yes, M will be evaluated using the higher discount rate because M is having the lesser certainty equivalent, correct? That's why. Now let's come to the other techniques. Sensitivity analysis. Okay. Now, sensitivity analysis. Okay, first of all, before sensitivity analysis, let us understand what is meant by capital budgeting. So students, capital budgeting is a model, correct? Is a calculation model in which you do a lot of calculations, correct? Which needs some inputs. What are those inputs? Cash inflows, cash outflows, discount rate, correct? Then you also take time. What is the time horizon of the project? 2 years, 3 years, 10 years, 11 years. These are all inputs, correct? Okay, sorry, Pooja. I'll show you that. This is project M. Okay. And this is project N. This is the solution for project N. And this is our conclusion. Okay, fine. Now, as I was saying that, first of all, we were trying to understand that what is a capital budgeting. Capital budgeting is a model, right? It's a model in which these goes as inputs. And this is a model, right? When you put all these inputs in your mathematical calculations, it throws an output. Mostly that output is NPV, right? Mostly. So sometimes you will calculate IRR, sometimes you will do other things, payback period, other things, but the model remains same and mostly the input remains same. This is your output. So NPV is your output. There are certain set of inputs and there is a model. Now, what is sensitivity analysis? Sensitivity analysis says that what is the impact of any change in any of the input will have on the output. Simple. Change of input that would result in change of output. So if I change cash inflows from 1 lakh, let's say, to 1,10,000, then what is the impact on my output, which is NPV? If I change my cash outflows by 10%, then what is the impact on my NPV? If I change my discount rate from 10% to 12% or from 10% to 8%, what is the impact on NPV? If I change the time horizon, instead of 3 years, if my time is taking now 4 years of the project, what is the impact on NPV? So this will calculate the change of output in relation to some of the change of the input. That is called as sensitivity analysis. And using this, we will try to identify NPV is sensitive to what? We will try to answer this question, right? NPV is sensitive to what? Sometimes it happens that even if you change the cash flows by 50%, still your NPV does not change. Correct. We will see that through some of the questions. But sometimes it happens that even if you change your discount rate by even 1%, your NPV will change drastically. That means your NPV is most sensitive to that discount rate and it is least sensitive to the cash inflow. We will try to understand this through this example now. Okay. So question number 8, it says that from the following details relating to a project, analyze the sensitivity of the project to the changes in the initial project cost, annual cash inflow, and cost of capital. Now, students, it is very easy for you to understand this. Why? First of all, it is asking you to calculate the sensitivity. We just now saw sensitivity is always output in relation to an input. What are the 3 inputs here? Initial project cost, which is cash outflow, annual cash inflow, which is the cash inflow, cost of capital, which is the discount rate. So these are the 3 inputs that are used in this model. They are saying that if these 3 inputs, we change them, what is the sensitivity of the project? How will the output change, which is the NPV, how it will change? So the base case scenario means whatever is there as a base case, correct? And then we will introduce the changes in the input, correct? Because for calculating the impact, you should know that what is the base. Then only you will be able to calculate the impact, right? You will be able to calculate the changes. So the initial project cost comes as 1,20,000, annual cash flows is 45,000, project life is for 4 years, and the cost of capital is 10%. Identify which of the 3 factors the project is most sensitive. They have told you 3 factors, right? 1, 2, and 3. It is also asking you to calculate that against which it is the most sensitive if the variable is adversely affected by 10%. If all these 3 factors are adversely affected by 10%, then which one is the most sensitive one? Hitesh, okay. They have given you the annuity factor of 10% and 11% both, okay. Now, without wasting any time, let us attempt this question. Solution. So first of all, we will first calculate what is the base case NPV, correct? If nothing changes, everything what is given in the question is like this, then what is this? So the present value of cash inflow will be calculated how? 45,000, right? Multiplied by 10% is 3.169. Then project cost minus 1,20,000. So this, if you calculate, it comes as 22,605. Okay, if you multiply 45,000 with this number and reduce 1,20,000 from that, that comes as 22,605. Hitesh, your answer is correct. 22,605. Now, this is our normal scenario. Now, the question is saying that all these three factors have been impacted by 10% adversely. So, what we are trying to say, first of all, let us take cash inflow. If cash inflow is adversely impacted by 10%, that means instead of 45,000, the adverse impact on cash flow will be 45,000 multiplied by 90%. Correct? Because 10% we have to reduce. One minus 10%. That is the impact of adverse impact here multiplied by 3.169. And this minus 120,000 remains same. So students, please note here, we are changing one factor at a time. In from base case to cash inflow case of 10%, we have changed only cash inflows. Correct. So it comes as 83,000. Sorry, 8344.5. 8,344.5 rupees. Now in this case, let us change the project cost. So this remains same. 45,000 multiplied by 3.169. The project cost has to be adversely affected. If the project cost has to be adversely affected, we are not going to reduce it, we are going to increase it. Minus 1,20,000 multiplied by 1 plus 10%. Okay. So it will become 1,32,000. So this comes as 10,605. Hiral is asking, sir, in risk adjusted method, higher risk, higher return project is accepted. No, Hiral. Don't conclude that. In risk adjusted method, higher risk, higher return project is accepted. In certainty equivalent method, high risky project is rejected is correct. No, Hiral. You can't conclude that in such a way. See, both of them are evaluating in the same lines. Okay, whether it is risk adjusted method or whether it is certainty equivalent method. Both of them are evaluating in the similar lines. The answer will remain same. The same project will be accepted or rejected under both the scenarios if certainty equivalent is calculated properly and the RADR, the risk premium in RADR is also calculated properly. Okay. Hitesh, we are adding 10% here because in this case, we are saying that cash outflows are adversely affecting, right? Because the question is saying that all the three factors are adversely affecting by 10%. In this case, we have assumed cash inflow is affected by 10%. In this case, we are assuming project cost is impacted by 10%. Very nice, Karthik. Karthik has also started giving answer 10,605. Hitesh, you're right. 8344.5. Then the last factor is the interest rate. So instead of interest rate of 10%, if we have to adversely affect this 10%, we have to increase it, right? To 11%. So 10% multiplied by 1 plus 10%. This means that it has to be 11%, right? Then only, because adverse impact, how it will come on NPV? If you increase the discount rate, then only your NPV will go down, correct? That means it is a negative impact. So now 45,000 remains same, but instead of 3.169, we will take 3.103, okay, which is the adversely impacted amount. And here we will take 1,20,000 as it is. And hence the net amount is coming as 19,635. Simple. Right. Karthik, you're right. 19,635. Now we have to calculate the percentage change here. Okay, so 83. Okay, let us calculate it like this. 22,605 was our base amount. The adverse impact is giving it this much. The original amount was this much into 100. This gives us 63.08 percentage. Similarly, here if we see 22,605 was the base case, this is the revised amount divided by 22,605 multiplied by 100. This will be somewhere around 53.08 percentage. And similarly, here it is 13.14 percentage. Very nice. Hitesh, you're right. Karthik, you're right. 163.08. Hitesh, you're right. 63.08. You, Bharadwaj, you're right. Then Karthik, you, Bharadwaj, Hitesh, all of you are right. Perfect. So now comes the conclusion part of this concept as well as this question. So I'm writing here percentage change in input, percentage change in output. 10%, 10%, 10%, correct? This is for cash inflow, this is for cash outflow, and this is for discount rate. That's how we did. Very nice. 53.08. Karthik, Hitesh, you, Bharadwaj, 13.14. Very nice. This is the right answer. Okay. Now, percentage change in input is 10, 10, 10 in all the three cases, but percentage change in output is different. So a 10% decrease in cash inflow is leading to 63.08 percentage of reduction in NPV. 10% increase in cash outflow is leading to 53.08 percentage decrease in NPV. 10% increase in discount rate is leading to 13.14 percentage decrease in NPV. Can you tell me which factor is impacting the NPV most? The change in that factor is impacting the NPV most. This one, right? Because for 10%, it is taking the NPV down to 63 point, down by 63.08 percentage. So we can say that this is the most sensitive factor, and hence we cannot afford any estimation error in the cash inflows, because the moment you do that, your NPV calculation is gone. Correct. This is what you understand from this. Your NPV calculation, while you do NPV calculation, your cash inflow has to be properly estimated. That is an additional thing that it is. Yes, Pandava Gayatri, you are right. Project is more sensitive towards the changes in cash inflow. It is the most sensitive. Okay. Okay. Now let us come to the next topic, which is again related to this. Just now we studied sensitivity analysis. Now we are studying scenario analysis. So students, in sensitivity analysis, we change only one factor at a time, right? So sensitivity, what we did is changed one factor at a time. At one time, basically, I mean to say, because first we did for cash inflows, then we kept cash outflow and discount rate same, like that. But scenario analysis, we have different scenarios. Scenario 1 will be let's say 10%, sorry, annual cash inflow, let's say, is 1 lakh. Cash outflow is 50,000 and discount rate is 10%. This is scenario 1. Scenario 2 will be 1,20,000. Cash outflow becomes 2 lakhs. Okay, and discount rate becomes 8%. So in scenario analysis, the set of inputs will be different. It's not that in this cash outflow will remain same and you will only change cash inflow. No. These set of inputs are different for different scenarios and you have to calculate the NPV for that. Okay. Now, Karthik is asking, it is always the case that change in cash inflow is most sensitive. We cannot say that or we cannot conclude that. But in some of the cases, like in the previous example, why we are seeing is that the major part of your NPV is getting impacted by your cash inflow. Correct. Hitesh is saying change more than one in scenario analysis. Yes. Change comes in more than one input. Okay, all the inputs will change. There are different set of inputs. That is the beauty of this. Okay. Now let us come to the last question of the session today. Any doubts here? Scenario analysis and sensitivity analysis is clear, right? Sensitivity is one input change at a time. Scenario analysis is changing all the inputs in different scenarios. Okay. Now this is question number 9. This is also a very good question. Okay. Now, question number 9 says that P&R Limited is considering a project. Thanks, Siddharth. Thank you, Karthik. Okay. P&R Limited is considering a project with the following cash flows. Year 0, year 1, year 2, year 3. Cost of the plant, which is an outflow. Running cost is also an outflow. Savings are inflows. Correct? This is inflow. This is outflow. And this is also outflow. Okay. The cost of capital is 12%. Okay. The discount rate is 12%. Measure the sensitivity. They're asking sensitivity of the project to changes in the levels of plant cost, running cost, and savings. Consider each factor at a time. They are saying that consider only one factor at one change. Okay. Such that the NPV becomes 0. Here there is a twist in question. Okay. The question is asking us that what change we have to bring in plant cost to make NPV as 0. Currently, your plant cost is how much? 12 crores, right? So they are saying that how much change we should do in this 12 crore to make NPV as 0. Similarly, what change we should do in these running costs so that the NPV is 0. Similarly, what change we should do in this saving so that the NPV is 0. But we have to take one factor at a time. They've given us the present value factor, determine the factor which is the most sensitive to affect the acceptability of project. Okay, this is the question. Hiral is asking why in initial project cost we add 10% and in annual cash flow we less cost by 10%. I didn't understood. Okay, a good question. Very good question. Let me go back to the previous question. So Hiral, if you note, the question says that identify which of the 3 factors the project is most sensitive if the variable is adversely affected. Okay, adversely affected by 10%. Now, what do we mean by adversely affected by 10%? If it is a income, cash inflow, adverse impact of income will come once you reduce the income. Once you reduce the cash inflow, right? Hence, we have reduced it here. However, if you talk about the initial project cost, the adverse impact on account of initial project cost will come once you increase the project cost. Okay. That is why we have used the different amounts there. Okay, Hiral. Now, let's come to the solution. So students, if you see, this question is a bit different than what we did earlier. it has not given us 10% adverse effect this time. It is asking us to calculate that what is the percentage impact that we have to bring in the inputs so that our NPV becomes 0. First of all, we have to calculate the base case NPV in this case as well, right? First of all, base case NPV, which is as is NPV is what? So let me put like this: year 0, 1, 2, 3, and then total. Okay. So cost of plant, year 0, it is 12 crores, right? Running cost, year 0, it is nil. Then it is 4 crore, 5 crore, and then 6 crore. Okay. Then savings, nil for the year 0, 12 crores, year 1, 14 crores, year 2, and 11 crores, year 3. Okay. You just tabulated this information that is given. So the net cash flows 12 crores. Okay. Here it will be 12 crore minus 4 crore. So this will be 8 crore positive. 14 crore minus 5 crore, 9 crore positive. 11 crore minus 6 crore, 5 crore positive. Okay, so this is the net cash flow. Now we will multiply it with the present value. Present value is given as 1, 0.892, 0.797, and 0.711. Okay, very nice, Hitesh. 8 crore, 9 crore, 5 crore, you're right, and minus 12 crore for 1 year. So the NPV, we can just multiply the present value factor with the net cash flow, right? This is just a simple capital budgeting exercise till now because we're calculating the base case NPV, right? So here it is 12 crores. Then it is 7 crore 13 lakh 60,000. Then it is because we have multiplied 0.892 with 8 crores. Okay. Then the next one is 7 crore 17 lakhs 30,000. And the last one is 3 crore 55 lakh 50,000. So hence, if we total this plus this plus this, then nice, Hitesh, the answer is right. You are mentioning there. NPV is 5 crore 86 lakh 40,000. Okay, students. So NPV is 5 crore 86 lakh 40,000. This is the base case NPV. Now, quickly, let's come back to our business. So first of all, it is asking that for all these three factors, calculate that how much we need to change these factors so that NPV becomes 0. So let us first start with a very simple one, plant cost. Plant cost currently is 12 crore. NPV is how much? 5 crore 86 lakh. Correct? Simple. We have to increase the plant cost. Plant cost to be increased by 5 crore 86 lakh 40,000 to make NPV as 0, right? Correct? Okay. Right. Hitesh, Bharadwaj, Karthik, all of you are right. So percentage change, if we have to calculate in project cost. So 5 crore 86 lakh 40,000 is the change divided by 12 crores multiplied by 100. So that means it has to be changed by 48.87 percentage. The plant cost has to be increased by 48.87 percentage to make NPV 0. Now let us come to the running cost. 48.67, right, Hitesh? So the running cost, also need to increase, right? Then only your NPV will go down. Like your project cost is increased, hence your NPV is going down. Your running cost also needs to increase. Now, how much it needs to increase? 5 crore 86 lakh 40,000 is the amount by which it has to increase, right? Divided by, now we will just do a weighted average. The present value weighted average of all these. Okay. So how much it is? 4 crores multiplied by 0.892 plus 5 crores multiplied by 0.797 plus 6 crores multiplied by 0.711. Okay, students? Simple. So in the denominator, we have taken the present values of the running cost, and in the numerator, we have taken the percentage change. So this comes as 49.61 percentage. This all multiplied by 100, correct? So the running cost has to be increased by 49.61 percentage, right, Hitesh? You're right. Then C part comes as savings. Now for NPV to be 0, savings has to come down, correct? Running cost has to go up. Plant cost has to go up. Savings has to come down. So simply 5 crore 86 lakhs 40,000 divided by first year savings is 12 crores 0.892 plus 14 crores 797 plus 11 crores 0.711 multiplied by 100. So if you see how much savings has to go down to make NPV 0, it is 19.75%. So now I am putting all these three things here, and plant cost, then we have seen running cost, then we have seen savings, right? It has to go up, it has to go up, it has to go down. Plant cost has to go up by 48.87 percentage. Running cost has to go up by 49.61 percentage, and savings has to go down by 19.75 percentage to make this would make NPV as 0. So Hiran is asking why in cost of plant we are not multiplying with the PV factor, because it is at 0. That's why. Because PV factor we will start multiplying from the year 1 end, 2nd and 3rd end, right? Not from the 0. Because cost of plant is incurred as on today. That's why. Very nice, Hitesh. Very good. Bharadwaj, you're right. Now, actually, Hitesh has already answered, but I am not revealing his answer. Now, my question is, can all of you attempt this question? Which factor is the most sensitive factor for NPV? Since we have done sensitivity analysis, I just want to hear it right. Karthik is also asking the same question what I'm asking to all of you. What is the most sensitive input here? Please think out of the box, okay? And please post whatever it comes to your mind. Please don't feel right, wrong. Karthik saying savings. Shreya is saying savings. Prabhas is saying running cost, okay? Okay, so I'll tell you. See, don't get confused by the higher percentage here. What? Okay, now let's analyze this. Only 19.75 percentage has made NPV as zero. However, running cost has to change by 49% to make NPV as zero. So do you think that running cost is more sensitive or savings is more sensitive? Savings is more sensitive, right? Because only by changing, let's say 20%, it is more sensitive. Okay. So don't go. If we are analyzing the percentage change in NPV, then you should see the highest percentage. Correct. But this is a percentage change in input. And hence you should see the lowest percentage here. Okay. Now, Viral is saying savings, Siddharth savings, Anita savings, Bharadwaj saving, Pooja, why should all these be increased? Is it not enough we adjust? Anyone thinks, sir? No, Pooja. Pooja, please understand. Plant cost is increasing, running cost is increasing, savings is decreasing, but everything is happening one at a time. If plant cost increase, running cost and savings, no change. If running cost is increasing, plant cost and savings, no change. If savings is decreasing, then running cost and plant cost, no change, because it is mentioned in the question, one factor at a time. Okay. Gehani Hariram saving, Karthik Gupta saving. Yes, you're right, Karthik. That's what I was trying to explain. Just 19.75% change can make it zero, while it has to change by 49%. Mancha saving, Pooja discount factor. Bhargava is sensitivity based on inflow, sir. Yes, it is always based on inflow. Okay, Prabhas. Okay, Prabhas, don't lose your heart. Keep attempting. Okay. So today's session is over. With this, I think we have ended the understanding one more level on the capital budgeting. So please do revise well. Please take care of you and your parents. Until then, goodbye, good night. Thank you. Session over.